Hi everyone, welcome back. So up to now we've now covered group accounts, previous day 35%, interpretations another 35%, 70%. We just touched based on section D as well, 10%, and now we are down to the final 20% of the syllabus, which is section B, recognition and measurement, of which financial instruments we've discussed in our previous segment. Now, for the moment, let's take a look at employment benefits, which is discussed in IAS 19. So, when you're in employment, there's a cost attached to the employer. And what are the types of employment benefits which we see in practice? We have the usual short-term employment benefits, monthly remuneration, post-employment benefits, any other long-term employment benefits, various schemes you have, and benefits upon termination. So, of these four categories, what is going to be our focus for F2? Our focus is going to be on post-employment benefits, which is the second bullet point which you see on slide 82. So, what do you mean by post-employment benefits? Basically speaking, it refers to pension plans. Now, that's our focus. So, pension plans can be broadly categorized into two based on how they operate. One, we call it as a defined contribution scheme. The other is called a defined benefit scheme. Now take in Sri Lanka, take the EPF. That's a defined contribution. Every month we know how much to contribute, how much from the employee, how much from the employer. So accounting is less complicated. You account for it according to the basic accruals basis of accounting. Any amount overpaid or underpaid would be adjusted as a prepayment if you have paid more, or an accrual if you are falling short. So less complications there. Now, defined benefit scheme, what is that? That is where you define the ultimate benefit that the employee would be getting. In Sri Lanka, if you take the gratuity, if an employee works for more than 5 years in an organization, let's say he works for 8 years, then you are entitled to half your final salary into the number of years of service. Now that becomes a complicated calculation, because we can't exactly say how many people will leave, how soon they will retire. Yes, and lots of complications involved. Now to do this computation, we need the services of an actuary. And once the actuary gives us the numbers for F2, we need to be focused on the accounting. Now just another point which I would like to mention on the defined contribution scheme is that once the contribution is made, thereafter the employer's liability ends there. If the investor messes up the fund, then it's up to the employee to bear the loss. But in a defined benefit scheme, the employer has to make sure that the employee gets the defined benefit. Okay, so now to focus on this a little bit more, let's get on to a past paper. Let's look at November 2011 question number 4, where it says that QWS operates a defined benefit pension plan for its employees, and at the beginning of the year they are giving the value for the plan assets as well as the plan liabilities, and then they are giving the finance charge on the scheme as 7%, and the actuary who does the calculations are saying that the current service costs of having this workforce for the year as 300,000. During the year we have made contributions to the plan up to 400,000, and to retired members the plan has paid 220,000 during the year. And so the general requirement of this type of question is for the examiner to ask the actuarial gain or the actuarial loss. So which is not a very difficult thing to do. Actually this topic is fairly straightforward. So you got to prepare the respective accounts of the plan assets and the plan liabilities, and generally all the numbers are given: the opening asset, the closing asset, the opening liability and the closing liability, and then the finance charge which you can calculate on the opening balance, you take it to the income statement, and contributions paid you debit to your asset having paid through cash, and any benefits paid to members you take off from your asset by crediting and deduct it against the liability by debiting to the liability account. And the balancing figure of the plan asset and the liability would be your actuarial gain or loss, which you set off from the two respective accounts and present it in the income statement under OCI, other comprehensive income, again under the subcategory, as I told you on day one, under items which cannot be reclassified. The interest cost and the interest income, you take it to the income statement, and the current cost is of course is an expense, and the net pension asset or liability, you take it to the balance sheet. And now if we can focus on share based payments, so what some employers do is, rather than paying salaries, you offer shares. It's about share option schemes granted to employees, and whether we should account for it. Some people argue saying, look, there is no cash payment, there is no transaction, nothing to account. But in substance, why are we giving these share options? It is as a result in turn for employment services rendered. So we say it's a cost for the employer, and which is discussed under IFRS 2. So there are two broad types of share based payments. One scheme is where you give share options which we call equity settled. The other scheme is where a cash payment is made where we call it cash settled. And now if I can take you through quickly a past paper question, let's focus our attention to March 2012, where they say that giving two transactions, as now you see in slide 92, KOL granted a share option scheme to 400 people, and you would be entitled to the option if you work for 4 years. Now a share option means it is equity settled. So what you do is, each employee is given 1000 options, and you multiply by that by the expected employees at the end of the year. You start with 400. In year one, so many people left. Estimated number of resignations is then again given, and that you multiply by the fair value at the grant date, and into the fraction 1/4 in the first year, 2/4 in the second year, so on and so forth. Then you would get the cumulative charge and the annual charge. And remember, you recognize the annual charge as an expense, and the credit is taken under equity because it is it's settled by way of share option. It's equity settled scheme. Now why I mentioned that is, even the cash settled scheme is very much similar. It operates the same way, but at the end of the day there is a cash payment involved, So when you account for it, therefore you take it as a liability, you debit your expense. Now in equity settled scheme you took it as a reserve. Now here you take it under liabilities. At the same time, because the liability has to be settled, at each balance sheet date the fair value of the option is revalued, is remeasured. So under equity settled scheme you take the fair value at the grant date and keep it at that, but under a cash settled scheme you update the fair value at each balance sheet date in arriving at the respective charge. Thank you very much, and I'll be back soon. Hi everyone, welcome to the final lab. We have gone through almost the entire syllabus. So let's take few minutes and concentrate on reporting of substance of transactions, and thereafter to look at some vital examination tips. If you take as an example, I'll take from FO. Let's take a lease. What happens when we take, say, a motor vehicle on a finance lease? Who is the legal owner? The leasing company. But in whose books do we capitalize the asset? In the books of the lessee. Yeah. Who is using the vehicle and getting a benefit? Obtaining the risks and rewards of having the asset? The lessee. In whose garage are we parking the vehicle? In our house or in the leasing company? No, in the lessee's garage. Which means the risks and the rewards of having this motor vehicle is with the lessee. As a result, we would capitalize this in the books of the lessee. That's what we mean by reporting the substance of a transaction, where we would in financial reporting consider the commercial substance, which sometimes can be different to the legal form. So we'll have to ensure that financial statements represent faithfully the transactions which have been carried out, and that it reflects the true economic substance of the events and not merely their legal rights. Now let's take a few more examples. Let's say we have a debtor's balance. Recovering that is a little difficult. So we hand it over to a factoring company who gives us the money, advances the money, and thereafter it's up to them to collect the debtors. Now, can we de-recognize the debtors from our books to say, look here, debtors have been collected through the factor by paying a fee? Or is it that we are getting a loan from the factor, keeping our debtors as a security? Which is why I earlier said that we got to look into the substance, the economic reality. So, if the debts have been handed over with no recourse, it means that if something happens, the factoring company cannot revert back to us. If that's the case, we can de-recognize the debtor. Let's say if the debtor's balance was, say, 10 million and the factor gave us, let's say, 9.8 million, we can recognize the 9.8 million into a bank, get rid of our debtor's balance of 10 million, and the difference of 200,000 is our finance charge. Done. But if there is recourse where the factor can transfer any debts which cannot be recovered back to us, that means they are not taking any responsibility. Which means we cannot de-recognize the debtor. Which would mean that you hang on to your debtor in the balance sheet and recognize the money advanced by the factor as a loan by debiting to bank and crediting to loan. That's one example, debt factoring. And then we get into sale and repurchase agreements, where let's say I sell my building to a bank with the condition that I am compelled to buy it from the bank in 3 years' time. Now, what is the business of a bank? Their business is to give loans. So what is actually happening here? The bank is lending me some money over a 3-year period, keeping my house as a security. So can I de-recognize the building or my house from my balance sheet saying I sold it, although that's how we structure the transaction? We can't do that. We must always look at the economic reality. Now, according to my example, we cannot de-recognize the asset from the books, but to recognize the money advanced by the bank as a loan. So we talked about factoring of receivables. We spoke about sale and repurchase agreements. And another thing which we see in this reporting of substance is the sale and leaseback. Sometimes you sell one of your assets and get it back on a lease. And some members try to keep it as operating lease, because then you recognize the higher charge and charge it to the income statement. But in substance, if it gives the characteristics of a finance lease, then we must book in the liability, bring the finance lease liability. Now some members try to avoid this. Why is that? Because if you bring in the liability, then your gearing ratio goes for a 6. Maybe that we have given a covenant to a bank to maintain the gearing at a manageable level, below a particular level. So we have to watch out for these transactions. And another transaction is where when we have consignment sales, to exactly identify the point where the sale takes place, whether is it when the consignee receives the goods from the manufacturer or when they sell it in turn to another party. So, dear students who are preparing for the exam, watch out for substance of transactions. Again, you have to write and explain, give your argument, and this can be in the section A of the question paper. So members, coming down to the last couple of minutes, if we can look at a little bit of examination technique as to why students fail the exam. Most students fail because they are inadequately prepared. Or in analysis questions, say the report, they lack commercial awareness. You just say something, some expense has gone up or the GP has come down without relating, without looking at the commercial substance. And then lots of children say, sir, the exam was easy, but we ran short of time. So time management is critical, and another important thing is show clear workings, so that even if the final answer is wrong, the examiner can award some marks for the steps. And some children, they give a nice long answer by repeating the same point. CIMA examiners are smart to spot that, and you won't be getting any additional credit. Remember, your examination is a time bomb. The moment they give the scripts, yes, the clock starts ticking. So the student is continuously under pressure for time. So the trick is to be ahead of the required run rate, because if you become under pressure of time, then our chances are remote. Then you can't think. So my special advice for you as we bring this program to a close is this. We got to capitalize on the 20 minutes of reading time. Now that's like a power play. Don't just wander about the question paper seeing what areas have come where you haven't studied. Pointless worrying anyway. My advice is focus on 1 or 2 areas where you have studied and you try and crack the answer. Crack the answer into the, you are not given your answer booklets. In the question paper you can scribble some points down, do some calculations, whether it may be a share-based payment or a pension fund or a financial instrument or maybe a 10-mark consolidation. Yes, you can't use the calculators, but no one is stopping you from using the pen. Now why I say is that then no sooner the writing time commences, that is the 3 hours writing time commences, you can quickly jot that answer down into your answer script in double quick time and save time. Let's say you manage to crack 2 questions in the reading time and you scribble it down, let's say taking say 10 minutes or let's say taking 15 minutes. For 2 10-mark questions, ladies and gentlemen, you get 36 minutes at the exam. So if you have taken 15 minutes to scribble it down what you cracked earlier, still you have saved 21 minutes. So now when you have 21 minutes as a saving, then you can comfortably get on to the main questions, the report, the consolidation or any other question, and you have the luxury of taking 3 or 4 additional minutes, which makes a world of difference. So for several questions, when you can take 3 or 4 additional minutes, definitely you are not under any kind of pressure, which will definitely increase your chances of passing. So members, cover the entire syllabus, do many questions on a time basis. Please do some mock exams where you do the real thing and put everything together. And whilst we bring this session to a close, let me wish you all the best. And may God bless you all, and thank you for your participation.